Welcome to this edition of IBFD's Tax Takes News and Views, bringing you the week's tax news in a nutshell. I'm Barry Larking, Special Counsel at the IBFD, and with me for our Beyond the News interview is Stuart Gibson, IBFD's Chief Editor, Global News in Washington, D.C. On today's show, some countries are raising taxes and some are cutting them, while still others are doing a bit of both. Austria may have to pay interest on late VAT refunds, but is it worth claiming? And India grants an exemption to its senior citizens, but not quite. These and more, including Stuart Gibson's Beyond the News interview with Sandy Radmanesh, tax attaché at the German Embassy in Washington, coming up on IBFD's Tax Takes. First, we turn to the top news of the past week, as reported in IBFD's Tax News Service. While some countries are finding new ways to increase government revenue, others are spending money on tax incentives, and some are doing a bit of both. Costa Rica falls into the first category as it introduces a host of cost-cutting and revenue-raising measures that include moving from a territorial tax system to a worldwide tax system. These measures aim to implement a 3-year economic recovery plan that's just been initialed with the International Monetary Fund. Argentina and Suriname are also hiking taxes in response to the pandemic, as Argentina targets the rich with a wealth tax and Suriname introduces a solidarity tax on corporate and individual incomes. Argentina says its wealth tax will be a one-off emergency measure, while Suriname's new income tax should expire at the end of this year. But of course, we all know that temporary taxes have a habit of becoming permanent. Indian M&A transactions may get more expensive if the Modi government has its way. The just-released union budget would prevent taxpayers from claiming depreciation for goodwill, even if the goodwill was acquired through a business acquisition or restructuring. This was one of the more noticeable items in this year's Indian budget that made no changes to corporate or individual tax rates, but did include tax breaks for aircraft leasing, foreign banks, and startups, as well as relaxing some enforcement rules. Cameroon is enhancing a range of existing tax incentives, as well as introducing new ones for digital startups, while Hong Kong is looking to offer new tax breaks for investment managers and the funds they manage. It's been 15 years since the European Court of Justice handed down its groundbreaking decision in the Marks and Spencer case, and it seems that the dust still has to settle. That case laid down the basic principle that a parent company can deduct losses of a foreign subsidiary only if those losses are final. Since then, a string of cases has sought to clarify how that judgment applies to similar fact patterns, such as where losses are made by foreign permanent establishments. The latest referral to the EU court raises the somewhat metaphysical question whether losses can be final if the PE has closed down but could theoretically reopen and earn profits that the losses could be set off against. This will no doubt not be the last we hear on this subject. Has your company been waiting for a VAT refund for an unreasonably long time? According to the EU's Advocate General, you may be entitled to interest on the overdue amount, even though nothing in the law says that you are. And although the AG's opinion applies to a specific Austrian VAT case, it could also apply in other EU countries, depending on the precise facts and circumstances. Of course, with interest rates at a record low, will it be worth taking the VAT inspector to court? Tax havens remain under pressure as Denmark and Luxembourg take steps to discourage multinationals that channel funds through so-called non-cooperative tax jurisdictions. The steps include denying tax deductions for certain payments made to blacklisted jurisdictions and aim to implement EU instructions to all member states to introduce this kind of defensive measure. The Luxembourg rules will kick in from March, and if approved, the Danish rules will follow in July. And now moving on to other news. The European Commission has filed its appeal in the Apple state aid case. And with 13 billion euros at stake, perhaps it's not surprising the Commission wants another bite at the apple. And the UK is marching ahead with its post-Brexit tax and trade negotiations as it kicks off a new trade deal with Colombia, Ecuador and Peru. Future plans include a tax treaty with Peru and, for the financial sector, a market access deal with Switzerland. And finally, To mark its 75th year of independence, India is planning a special birthday present to some of its senior citizens aged 75 and older. Those who have only pension and interest income will be exempt from filing a tax return. That's because the tax will already have been withheld at source. I guess there's a limit to just how far India is willing to go to honour its elders. And now we go beyond the news for Stuart Gibson's interview with Sandy Radmanesh. Stuart.
Thank you, Barry, for your informative news report. I'm Stuart Gibson, Chief Editor of Global News here at IBFD. I'm joined today by Sandy Radmanesh, Tax Attaché at the German Embassy here in Washington, D.C. Welcome, Sandy.
Hi, Stuart. Thanks for having me.
So good to see you. We have a lot to talk about today, so let's dig right in. Many people in the tax world are wondering how Germany and other key players in the international tax community plan to engage with the new Biden administration in general and with Treasury Secretary Janet Yellen in particular. In fact, Secretary Yellen recently spoke by phone with German Finance Minister Scholz. What can you tell us about their conversation and what it may signal for U.S.-German tax and trade relations?
Well, good question. Very recent referrals. So first of all, I would like to say that the German government is really looking forward to working together with the U.S. administration, especially on international tax policy issues. And from our perspective, we absolutely understand that the U.S. administration has a myriad of issues to take care of under the current crisis. We are also following very closely the discussions in Congress about the new or next stimulus package and how the U.S. will deal with the challenges, the economic challenges of this crisis. However, we think that the tax challenges arising from the digitalization of the economy remain a pressing issue, and that these are more relevant than ever, not only with respect to the economic recovery in the post-COVID era, but also in terms of bolstering the fairness of our international tax system. We were very pleased to hear that the new Secretary of Treasury, Janet Yellen, considers the OECD process on taxing the digitalized economy as a top issue, and that the US would actively participate in the discussions. And we take this as a very hopeful sign that not only demonstrates the willingness of the US administration to merely cooperate on that particular topic, but that it also shows that the US intends to immediately engage with the international negotiations at the OECD. And in terms of those negotiations, we expect that the US would likely agree on Pillar 2, for those who are familiar with the topic, and especially with a view to Biden's Made in All America strategy, which includes a tightening of the current US GILTI rules, which would be more in line with Pillar 2. However, I have to say it is difficult to predict whether Congress would sign up to such a change. So with this in mind, the question of grandfathering the GILTI is unfortunately not completely off the table. Although we received encouraging signals, and there is really good reasons to believe that Secretary Yellen will bring a more constructive approach to reach an agreement on both pillars this year. More work needs to be done to find common grounds on Pillar 1, and especially with respect to the US position under the previous administration. And people who are familiar with the discussions know about the safe harbor, which allows companies to opt out of whatever will be agreed internationally. I can say for sure that this kind of approach would not work and will not be supported by the other states of the inclusive framework. So just let me make a final remark on that question. I want to keep it brief. I think in this context, it should be pointed out again, and I have to emphasize this, both ministers prioritize a multilateral solution over unilateral actions. And we are very hopeful that this mindset will eventually prevent the fragmentation of the international tax landscape and lingering trade tensions.
Well, I think you just answered all the rest of the questions I was going to ask you, Sandy. You certainly led very nicely into my next question, because it seems to me there is a lot of optimism about the U.S. rejoining the inclusive framework discussions. And yet at the same time, we have this optimism, especially about Pillar 2, which is the global minimum tax. Many countries in the EU, and the EU in particular, are moving forward with plans to impose their own digital levies. Now, we know that Germany has not yet adopted a TST, but it is contemplating one should the talks fall through or the OECD does not meet its July 1 deadline. Is this something that Germany would consider doing if we did not have an agreement by July 1? And if so, would it be temporary until the OECD agreement was reached, or would it be permanent?
Well, again, good question. As I said before, Germany's focus right now is on reaching a multilateral solution in the inclusive framework. That's our priority. In our opinion, the OECD is the most suitable body to develop a comprehensive solution on taxing the digitalized economy. We actually believe that at least a political agreement should be possible within the targeted time frame. This, of course, requires everyone to be ready to compromise. And I think the willingness to compromise is key in the negotiations. Otherwise, we end up with different unilateral measures, which are unprincipled, we know that, and maybe designed as broad in scope as the Indian or the Indonesian equalization levy, and may go beyond just targeted digital business models. Of course, we've seen in the past that some EU member states, such as France, UK, Austria, you name it, introduced and even implemented and collected digital taxes, which are targeting digital advertising as well as other digital business models. And since the objective of these taxes is considered pretty much in line with what has been discussed under Pillar 1, we expect that a global solution would deprive these taxes of their political justification and leading eventually to their abolishment. So you've also mentioned the EU in this context. Last year in July, the EU Council asked the Commission to put forward proposals for additional own resources in an effort towards reforming the revenue side of the Union's budget. And the digital levy is one of those own resources which the EU seeks to introduce in the course of the multi-annual financial framework. Also, other contemplated resources apart from the digital levies are a carbon border adjustment tax and a revised EU trading emission system. And the proceeds of those new own resources should facilitate the repayment of the Union's borrowing that will be used to finance the Central European Recovery Tool, which is called Next Generation EU. So I think it's worth mentioning that the objective of the digital levy goes beyond seeking revenue. It also aims to address the same kind of issues that the OECD is targeting with respect to fair taxation. And this is why the EU initiative is not intended to interfere with the ongoing work of the OECD. And in fact, the Council conclusions negotiated during the German presidency at the end of last year confirmed that the EU member states' commitment to a global consensus-based solution by mid-2021. And the EU Commission has just recently released an introductory paper referring to an impact assessment with respect to the digital levy. So the paper actually proposes different approaches. And although it remains to be seen what the design of the digital levy will eventually look like, I think it's fair to say that the proposal in the EU paper, as far as I interpret it, that it's slightly different. They take a slightly different path towards taxing the digital economy than what has previously been discussed under the heading of digital service taxes in the EU. So in any case, and I would like to emphasize this again, it is our understanding that the work on these proposals at the EU level should not interfere with the advanced negotiations at the OECD.
I hear what you're saying. I wanted to pick up on something that you said, because you indicated that you thought it would it would be possible to reach an agreement on the political issues that remain around Pillar 1. And it reminds me of a very well-known quote. Well, I don't know how well-known it is, but a quote from a very famous negotiator, Herb Cohn, who said, negotiations always start before they begin and they always end after they're over. So assuming that we could see a political agreement by midsummer of this year, even if we didn't have all the technical details worked out, might countries like France and Germany be open to extending the deadline for reaching a final agreement, again, assuming that there was agreement in principle on the political issues?
Well, I think it's not just up to Germany to decide about leaving the door open for an extended deadline. So there are nearly 100, there are nearly 140 other inclusive framework member states that have a say in it. So, however, I would not exclude that a mere political agreement without the technical details could suffice for an extension of the deadline. But I think that's only provided that the political agreement will already meet the policy objectives, which we know are a fair international tax system and addressing the challenges of aligning the current rules to the digital economy.
That makes sense. I'm just trying to hold out the optimism theme here. We're kind of running out of time here, but I did want to touch on one other aspect, and it has nothing to do with taxation of the digital economy. As you know, Portugal has the presidency of the European Council now, and they've made it a priority to push the EU to expand country-by-country reporting to require some public disclosure of country-by-country reports. Can you tell us where things now stand with that effort and what role Germany is playing?
Yeah. Of course. So your question relates to the draft amendments of the EU Accounting Directive, which was initially unveiled in 2016. So back then, the Commission presented a proposal for public CBC reporting for businesses with a total consolidated group revenue of 750 million. And the proposal actually aims to insert an additional chapter in the directive to report on income tax information. And I think it's interesting to know that the call for amendments came from the EU Parliament after the Panama Papers scandal. And well, I think this also explains the twofold objective of the amendments. One is to enhance public scrutiny of corporate income taxes, and the other is further fostering corporate transparency and responsibility. So to your question, what's the current state of these negotiations? Until just recently, the negotiations at the EU level have come to a stall because there was actually substantial disagreement, not only with respect to the content and the extent of the amendments, but also regarding the legal basis. And I think that's quite interesting, apart from the argument concerning the disclosure of business information in general, and in particular, the extent to which information will be open to public scrutiny. Some countries consider the topic more a tax than an accounting issue. And that issue should be rather discussed in the ECOFIN, the Economic and Financial Affairs Council, instead of the Competition Council. And I think it's not far-fetched to say that the latter agreement in particular may be driven by the fact that the decision in the ECOFIN require unanimity, whereas the decisions in the Competition Council only require 2/3 majority of the member states. So what are the very recent developments then? So in the last working party meeting of the EU Council 2 weeks ago, around about 2 weeks ago, actually 14 member states plus the Portuguese presidency voted for a change of the accounting directive, including public CBC reporting. This would actually establish the required majority. So Portugal currently holds the EU Council presidency and could start the final negotiations with the EU Parliament. And the EU Parliament has, in fact, already established its position in favor of CBC, public CBC reporting. However, right now it's not quite clear how Portugal will proceed. It might as well choose to take a little bit more time before the approval process to enlarge the majority in favor of the amendments. And as to the German position, because you asked, there are still evaluations going on to evaluate and balance out the pros and cons of public CBC reporting. And this is why we continue to uphold our scrutiny reservation in these meetings. However, I have to say, Minister Scholz has reiterated his support for the amendments because he considers striving for the highest possible transparency is crucial for a fair tax system and should therefore play a prevalent role for governments.
That was a very comprehensive and much appreciated explanation of how we got to where we are and where things stand. I guess it's watch this space. Our guest today has been Sandy Radmanish, tax attaché at the German Embassy in Washington, D.C. Sandy, thank you so much for sharing your insights with us and on what promises to be a very eventful 2021.
I hope so too. Well, thanks for having me again. It was a lot of fun to explain these kind of things. Thanks.
That wraps up this week's edition of Tax Takes News and Views, the week's tax news in a nutshell. From Barry Larkin and myself, thank you for watching. Here's hoping your week is not too taxing.